While traditional markets were closed during the recent Iran crisis, crypto's 24/7 nature revealed a terrifying flaw. Coin Bureau highlights how thin weekend liquidity led to a $300 million liquidation cascade. This volatility now threatens to infect traditional markets through tokenized assets like BlackRock's BUIDL fund. Yet CryptoWendy shows this exact real-world asset sector is exploding, quadrupling in value even during a bear market. She argues trillions in institutional money are just waiting for regulatory clarity to enter the space. Meanwhile, Lark Davis points to a different force entirely, Michael Saylor's relentless buying, which could theoretically push Bitcoin toward $200,000. So, is the market on the verge of a catastrophic liquidity crisis, or is it about to be flooded with institutional capital and whale buying? We break down which scenario is more likely.
In the latest video from Coin Bureau channel, we're shown a real-world stress test of the financial system that happened over a weekend. When missile strikes hit Iran, traditional markets like the NYSE were completely shut down, leaving investors stuck. The only market still running and pricing this massive geopolitical event in real time was crypto, specifically on decentralized exchanges. This event proved that 24/7 blockchain systems are technically way ahead of the old 9-to-5 banking schedule. However, it also uncovered a scary downside. Over the weekend, crypto market liquidity plummets because the big institutional players are offline. So, when the news broke, Bitcoin quickly dropped from around $65,000 to $63,000, triggering a brutal $300 million cascade of liquidations. This happens because of something called cross-margin leverage, where a loss in one position forces the exchange to sell your other assets, pushing prices down further and triggering even more liquidations in a vicious cycle. The really concerning part is how this connects to the traditional world. With billions in tokenized real-world assets like BlackRock's BUIDL fund now being used as collateral for crypto trades, this weekend volatility could easily spill over and cause chaos in the broader commodity markets. The video makes it clear that while always-on markets are the future, the journey there could be incredibly painful for retail traders who get caught in these low-liquidity liquidation traps. The video's core argument, that crypto's 24/7 nature is both its greatest strength and a significant vulnerability, remains highly relevant. The weekend effect is a well-documented phenomenon where thinner liquidity leads to exaggerated price moves. This creates a structural risk, especially as the tokenization of real-world assets, RWAs, continues to accelerate. The RWA market has surged to over $26 billion, a near four-fold increase in the past year, with institutional players like BlackRock expanding their tokenized funds, such as BUIDL, which recently surpassed $1.7 billion in assets. This growth directly connects traditional assets to crypto's weekend volatility, just as the video warns. While always-on markets are the future, the journey there could be incredibly painful for retail traders who get caught in these low-liquidity liquidation traps.
In the latest video from CryptoWendy, she dives into some wild stats about real-world assets, or RWAs. Right now, this market is valued at $25 billion, but what's really interesting is that only 12% of that is involved in DeFi. She points out that the combined market for just gold and silver is around $40 billion, showing how much room there is for growth. BlackRock is already in the game with its $2 billion BUIDL fund, which signals that huge financial players like JP Morgan and Morgan Stanley are seriously interested in this technology. The thing is, most of this action is still centralized. She highlights that tokenized RWAs, not even counting stablecoins, have almost quadrupled in the last year, even during a bear market. This growth comes from big institutions, not everyday traders. Wendy believes we're still in a bear market, and the real explosion will happen when RWA, AI, and DeFi come together. All this institutional money is basically sitting on the sidelines, just waiting for clear laws and regulations. Her advice? Keep an eye on projects that have the trifecta of AI, DeFi, and RWAs, as well as those with spot ETFs. The video's focus on the massive potential of real-world asset tokenization is spot on and reflects a major ongoing shift in finance. The speaker's point about institutional money waiting on the sidelines is validated by current events. Giants like BlackRock, Fidelity, and JP Morgan are not just experimenting, they're actively building infrastructure. For instance, BlackRock's BUIDL fund has already surpassed $2 billion in assets, demonstrating real-world product traction. Forecasts for the RWA market are incredibly bullish, with some analysts projecting a market size of anywhere from $10 trillion to $30 trillion by 2030 to 2034. However, the main obstacle remains the lack of regulatory clarity in the U.S., which the speaker correctly identifies. While there is progress, such as discussions between the SEC and CFTC for a joint approach and the proposed Clarity Act, the legislative process is slow and can be unpredictable. The integration of RWAs into DeFi protocols is accelerating, which could bridge the gap between traditional finance and blockchain, but this process is complex and faces hurdles in interoperability and legal frameworks. The narrative is shifting from speculation to tangible value, but the full deployment of institutional capital hinges on the establishment of clear and predictable rules of the road.
In the latest video from the Lark Davis channel, the discussion kicks off with the escalating crisis in the Straits of Hormuz, where Iran is rumored to be laying sea mines. This could effectively shut down a major oil route. However, there are some interesting counterpoints, like Iran granting safe passage to Bangladeshi ships and continuing its own oil exports to China. Plus, Saudi Arabia is ramping up oil exports through its Red Sea pipeline, potentially easing the supply crunch. The conversation then shifts to the markets, with Tom Lee suggesting higher oil prices might actually be good for stocks. On the crypto front, a personal Solana trade is currently at a loss. The big story is Michael Saylor's massive Bitcoin buying spree, funded by selling MSTR and STRC shares, which could theoretically push Bitcoin's price between $150,000 and $200,000. The video also touches on several stocks, noting that MicroStrategy's chart looks bullish. Tesla is in a downtrend, and AMD is holding at a key support level. A notable highlight is Oracle, which recently beat earnings expectations and now sits at its 200-week EMA after a 60% price correction, presenting a potential opportunity. The video provides a compelling snapshot of how geopolitical tensions and aggressive corporate strategy are shaping market dynamics. The situation in the Straits of Hormuz remains a critical flashpoint. Recent reports confirm multiple ships have been struck, and the U.S. military has destroyed several Iranian mine-laying vessels, escalating the conflict significantly. This uncertainty is keeping oil prices volatile, which in turn fuels concerns about inflation and potential delays in interest rate cuts, creating a challenging environment for risk assets like crypto. While some theories propose Bitcoin as a digital gold hedge, its immediate reaction to conflict is often a risk-off sell-off. Michael Saylor's strategy of relentlessly buying Bitcoin is a fascinating subplot. His use of STRC stock to fund these purchases is an innovative, albeit complex way to convert investor demand for yield into direct buying pressure for Bitcoin. This approach has cemented MicroStrategy's role as a de facto Bitcoin proxy. Meanwhile, the analysis of Oracle as a potential value play after its earnings beat is particularly timely. Recent analyst reports confirm a positive outlook, citing strong cloud growth and the early stages of AI monetization as key drivers that could justify a rebound despite heavy capital expenditures.
So, after looking at these different analyses, a clear picture emerges about the collision of old and new finance. All channels agree that real-world events, from geopolitics to the institutional adoption of tokenized assets, are now directly wired into crypto's 24/7 market. The consensus is that big money is here, and it's changing the game. But the perspective splits on whether this is a good thing right now. Is it a massive growth opportunity waiting on regulation, or a systemic time bomb linking traditional assets to crypto's brutal weekend volatility? The key takeaway: real-world assets are the battleground where this conflict plays out.